A very warm welcome, good morning, good afternoon. Welcome to HYCM's FX Week Ahead live market analysis with myself, Giles Coughlin. Very glad you could join us today. We will be looking through a number of significant events for this week, but we do have a very potentially quiet start to this week. So we'll be going through that, how to manage that, and what we can expect things to warm up. So first of all, remember the whole purpose of this look ahead webinar is for you to see how you go ahead looking at risk events as they're approaching. There's different ways you can trade, trading into them, trading out of them, waiting for them to happen. It's a skill in itself, and during the course of this webinar, you'll see over months and weeks how I go about trading these events. And the whole idea of these webinars is that it's a learning process. Now, it's not a signal trading service, so we are not providing signals. So even though we talk about entries, exits, different instruments to trade, it's all from an educational perspective, not a signal trading service. Now, the reason for that is because market conditions obviously change, and this isn't updated regularly, just once a week. So the idea is that you look at this process and then you learn these skills over time and you can implement them in your own trading. So don't forget, during the course of the webinar, we have a Q&A box. You can ask questions and I will answer every question. If you ask a question, pop it in the box. I will get to it at the end of the webinar. Aside from that, we'll get going. Now, the key areas we're looking at today is on the screen. We'll be looking at the ECB members' reaction to last week's strong flash PMI readings, having a quick look at the New Zealand business confidence, see if that finally helps lift the New Zealand dollar. Just be thinking about German manufacturing and whether that is going to be changing the ECB's monetary policy. We'll also look at the OPEC Plus meeting, very important for oil this. We will run through oil, what we're expecting from OPEC Plus. We're also running through gold. Again, gold is being pushed and pulled around on the Federal Reserve monetary policy. I'll explain exactly what's going on so you are understanding that. Also looking at US manufacturing in terms of non-farm payrolls as well. We'll be looking at the job market for the US, important at the end of this week, as well as looking at major pairs, and also capital preservation in quiet markets. So without further ado, we'll get into the main screens. So I'll just change this screen. We'll go over to our other screen. Now, one of the key things you need to realize in markets like this is that we have a very quiet start to the week. If you just take a quick look at the economic calendar, you can see that there isn't really much on today. There isn't very much on tomorrow. We've got a bit of business confidence from the New Zealand dollar, but aside from that, we're very quiet. And then things aren't really moving until Thursday, where we have the OPEC Plus meeting. So we've got 1, 2, 3 days. Now, also, here's a good learning point. You see, we're coming to the end of the month. Now, at the end of the month, what you get is something called portfolio flows or rebalancing. And portfolio managers, for instance, they will have certain requirements for their portfolio, something like, you need 5% of your portfolio has to be in US dollars, or you can't have more than 60% of your portfolio in equities. You have to have at least, 40% in bonds. And obviously, as you get to the end of the month, investment managers need to balance those portfolios so they are keeping to the fund's requirements. This can mean you get some what's called rebalancing flows. And rebalancing flows might show themselves in a very sudden shift in markets, and it tends to happen around the end of the month. Okay, so 28th, 29th, 30th, look out for that. Also, you get something called turn of the month phenomena. And around turn of the month, you tend to see equity markets rise. Now, why is that, you might say? Well, that's because if you think about it, when do most people get paid? They get paid at the end of the month. And if you are contributing to your pension or you are making a regular payment, most likely that will take place at the end of the month or the very beginning of the month as your pay goes in. So as a consequence, we tend to see a disproportionate gain in equity markets around the turn of the month. So Other things to note, and it's very important, we spend a bit of time on this. If you just take a look at the S&P 500, you'll see, look, we are right up at all-time highs. You see? Fresh all-time highs made. Now, there's something important here. Can equity markets keep moving higher? Absolutely, yes, they can. The medium-term bias for equity markets is tilted to the upside. Why? Because we have low interest rates from central banks, and we have broad fiscal stimulus from governments. Fiscal stimulus is government policy designed to prop up economies because of COVID-19. So in other words, governments, central banks around the world have thought, gosh, it's so hard for companies, we need to make conditions as easy as possible for them. That's why equity markets have been rallying so strongly. Do you see? What equity markets spoke about this V-shaped recovery? Well, we've seen that strength continue in equity markets. And what we've got to be careful of, and I'll give you a little tip here. What we've got to be careful of is markets like this. Be careful of buying in at the highs. Now, let me show you back to 2008, 2009. Remember that significant crisis? We saw equity markets fall from those highs, and they didn't get up to those levels back again until 2013. Right? So that took 5 years to get back up at those highs. So if you are trading equity markets, yes, their bias is to the upside. So look, if markets suddenly fell back down to that trend line, personally, I would consider that good value for buying at 4,200. But, and this is the crucial thing, I'll have my stops very tight. So my stops would be like sub 4,100. So I know,
just know OPEC forecast.
So I know that if my stops are the other side of that level, then if I get stopped out, it means, you know, there's been a near-term shift in direction. So be very careful in these markets that you don't end up buying in right at the highs, and then you have to sit through years potentially of drawdown. Okay, that's what you want to avoid, particularly if you're intraday trading. That is not even practical. So that's the first thing to bear in mind. Secondly, let's take a quick look at gold, because this is a very interesting market at the moment. Now, if you notice, we saw gold sell off very heavily. Now, the reason for gold selling off was on a monetary policy shift from the Federal Reserve. The Federal Reserve indicated that they were going to be tapering bond purchases. Now, remember, tapering bond purchases is the first step towards policy normalization. That's dollar strength. So dollar strength is gold weakness. If you go back to 2013, look what happened the last time the Federal Reserve tapered bond purchases. You can see that gold sold off around 20% of its value. So the market was understandably very sensitive to the Federal Reserve hinting at tapering bond purchases. So as a consequence, any retracements up to that 1830 can be considered suitable for shorting, as long as the Federal Reserve is looking at tapering bond purchases. Now, this is the key thing with the calendar. At the end of the week, on Friday, we have the non-farm payroll. Now, one of the concerns from the Federal Reserve has been that employment levels are not fully recovered yet. And that's right, employment levels haven't fully recovered. There is still a gap in the total unemployment rate. And you can see, look, unemployment is still at 5.7%. And according to some measures, it can be as high as 10%. Now, if you go back to pre-COVID-19, you can see, let's just get this right, you can see, look, levels are around sort of 3%. It's still 5.8% unemployment level. Now, what the Federal Reserve wants to see is full employment. They want to see full employment. So if the Federal Reserve see a really good employment number and a low unemployment rate, that will result in dollar strength, and that will sink the dollar further. So watch out for that. And as we come to the end of the week, look for those figures. If there's lots of positive reports about the non-farm payrolls, that will start strengthening the dollar into Friday. So it's reasonable to possibly expect dollar strength. Now, if the reports come in, it's going to be a very weak number, then the dollar may weaken into Friday. So this is going to be crucial. So be aware of that. Now, something else to know, a little bit of knowledge. If, like, one of the problems at the moment is in the US, people are supported even though they're not able to work. And those supports last until September. So if you think about it, why would you go and look for a job now in June if you know the government is going to look after you for 2 more months sat at home? You would quite happily maybe have 1 or 2 months sat at home, particularly if you're a low-paid worker. And it's some of those low-skill jobs that aren't being filled. And what people are expecting is once the government subsidies end, people are expected to go back to work. So at some point, some people say, well, okay, I'll look for a job now before everyone else starts looking for a job. So that's what the smart people will do. They're thinking, well, I'll get a good bit of choice. I'll get some good terms, and I'll go and get a job now while, there's lots and lots of jobs being offered. And there are lots of jobs being offered in the US, and there is relatively low demand. So that factor is going to be important. So look at those factors around non-farming. Now, the hourly earnings are quite strong at the moment, but that's disproportionately skewed because some of the low-paid wage workers are not in the workforce. So that just boosts the average hourly earnings. But look at that non-farm employment change. So 700,000 expected. If we get anything like 850, 900,000, anything like that would be very, very strong, and will be, you'd expect that to boost the dollar. So what would we expect? We expect dollar index strength, and we expect euro-US dollar weakness. Now, this is a short-term potential trade. One that I've entered just this morning was, to the euro-euro weakness, I'll give you a tip. If you ever want to know how to trade the euro-US dollar pair, remember the euro-US dollar pair moves exactly the opposite to the dollar index. So when the dollar index goes down, the euro-US dollar goes up. The turquoise line is the dollar index chart. So dollar index falling, euro-US dollar rising. Dollar index rising, purple line or turquoise line, euro-US dollar falling. You see the connection? Very, very, very solid connection. And if you invert the scale of the dollar index, you can see that it follows it perfectly. So that's why some traders call the euro-US dollar pair the anti-dollar index. Now you can see here, there is a technical setup called the Harami inside bar. Now let me show you what a Harami bar. A Harami bar is when the body of a candlestick is inside the body of the previous candlestick. So if this is the mother on the 7th of June, on the 8th of June, this is the baby. So this is the body, this is the baby, okay? The baby bar is inside the body of the mother bar. And this is the false break of the Harami inside bar. So you see there, you've got Harami inside bar, false break of the Harami inside bar, selling off. You've got Harami inside bar, false break of the Harami inside bar, market selling off. We now have Harami inside bar, false break of the Harami inside bar, and technically you'd expect to sell off back down to that 1.1860 region. Now, in an ideal world, you'd have some positive reports for the non-farm payroll. That would boost the dollar, sink the euro-US dollar. So look out for that. If you suddenly got that, that would be a very nice technical setup. But that's just worth having a look at the majors. In terms of the other majors, we're seeing a little bit of dollar strength creep back in since last Friday. So a bit of a dollar strength that is pressure on the majors, supports the euro-US dollar, and that supports dollar yen, US dollar Swiss franc to the upside. Now let's take a look at the calendar, what we have coming up. So a very slow start to the week. Now, when you have very slow starts to the week like this, then sometimes there's no point trading. It's just, you don't want to lose your capital. Now, you can still enter long-term positions. So a long-term position may be something like, the pound Japanese yen or the pound Swiss franc. You just take a look at the pound yen, look from a medium-term perspective. We have an upside bias. We're expecting the pound to keep accumulating. Very good vaccination program in the UK. £180 billion worth of pent-up savings, expectations that COVID-19 restrictions will be pulled back on the 19th of July. The general outlook for the pound is pretty strong. Although the Bank of England met last week, and although the initial reaction and the view of the Monetary Policy Committee was quite dovish, they have revised growth upwards, they have revised inflation upwards, so we could potentially enter. So the ideal entry would be down at this 152 potentially, or a breakout of this 155 level to the upside. It is possible to enter at market, and you could potentially use this trend line just to define and limit your risk. So if you're looking at getting in this for a low risk, high reward entry, that would be at market and stops just running below 153.50. Because the medium term expectation is for pound yen buyers. So that's something that can be taken from a more medium term perspective. You can just see there's a bit more optimism for the UK. But generally speaking, try to avoid getting into markets when there's not much going on. So Monday, very quiet. We've got some Fed members speaking. Look out for those. They can move the dollar, particularly this Fed's Williams. Now, he is a neutral Federal Reserve speaker. If he says anything hawkish, anything optimistic, that can really boost the dollar. So look out for that. Andy Haldane is speaking for the UK, but he's leaving the Monetary Policy Committee. So he's had his last meeting. He is a very, very big hawk. He, really was the most hawkish member of the central bank. So he will say something bullish, but it won't move markets because A, it's no surprise, B, he's leaving anyway. Secondly, just having a look at Tuesday, hardly anything going on, very, very, very low impact economic events, so it should be quite a quiet day. Wednesday, the only thing of any interest really is that business confidence out of New Zealand. That is interesting. If we keep seeing that move to the upside, that should give New Zealand dollar a little bit of strength. We may see a little bit of weakness in the Aussie New Zealand dollar as a result of it. Now, remember, the Aussie New Zealand dollar, I spoke about this a few times. We looked at that area here for potentially shorting. We looked at the 10-year bond yield from the Australian New Zealand 10-year bond yield. I was covering Forex Live last week, and this was just a article I put on the 24th of June, going back last week, and said first target was down at 1.0700 area. So I have closed my Aussie New Zealand dollar shorts, hit the target, and I'm just sort of neutral on the Aussie New Zealand dollar pair. Now, medium term, I am expecting this to keep moving lower. Has fallen into that key support level. If you are still trading the Aussie New Zealand dollar, look at the bond yield spread. This tracks price very closely. And as long as the bond yield spread keeps trending lower as of last week, then we'd expect this to weaken the Aussie New Zealand dollar. I wouldn't like to enter at market. I would give two options. One, enter up at that 1.0780 region, stops just above the 1.0826, or wait for this level to break and then potentially re-enter and look to the downside. So that would be one thing for the Aussie New Zealand dollar pair. So look out for that for business confidence. China manufacturing, that should be pretty strong. If that's a bad miss, look out for that to weigh on the Australian dollar. Okay, so that's worth looking at, but nothing's expected, but it does have the potential for changing market dynamics. Now, the main interest on Thursday is OPEC. Now, OPEC has absolutely been crucial for the oil markets. They have done a masterful job in supporting oil markets, and let me explain what's going on. Oil markets have kept moving higher and higher and higher. Why? Because demand in the second half of this year is expected to really rise. Now, the demand is expected to rise because COVID-19 restrictions are unwinding, the globe's being vaccinated, air travel starting again, construction's expected to pick up. All of this is used for oil. Secondly, politically, new oil development is not very attractive. Governments will not have an incentive to suddenly say we're developing and investing lots more in fossil fuels. That will be very unpopular politically. The politics now really want to promote green energy. So that means there's going to be less oil producers coming into market. Another bullish point. Thirdly, the US-Iran deal has been going badly. Now, if the US-Iran deal works, then that means more oil in the market, so oil's pressured lower. But with that not going very well, that has also been supporting oil. On Thursday, OPEC Plus are expected to give their decision, and what they're expected at the moment to do is to increase production, in other words, bring more oil into the market, 500,000 barrels. Now, what markets are saying is that it doesn't matter if they bring in 500,000 barrels per day, or even if they bring in even more, even if they bring in more like, 800,000 or 1 million, the market is not worried about that. So that means any dips lower into that 73 region can be considered suitable for buying. Okay, anything up against this trend line can be considered suitable for buying because there's nothing expected to change markets. Now, say the US-Iran deal gets agreed. This is what you'd expect to see. And this is what we saw the last time it was hinted that the US-Iran deal was agreed. We saw oil sell off very quickly, and then oil picked up as it looked like it wasn't, there wasn't any fundamental shift there. But let me say the US-Iran deal gets agreed, you'd expect oil to fall maybe down to 72, okay? But if oil did fall down, you'd expect those dips to be bought. Why? Because I don't think it's going to change the fundamental outlook for oil. Global vaccines, less supply in markets, the inventories have been drawing down. There's plenty of scope for this to recover, and that's why analysts like Bank of America have been calling for oil up at $100 a barrel. Okay, so some analysts are looking for oil to come all the way back up here. Right? So for me, oil's a buy on dips, but which dip do you buy in? I'd be very interested. Get down to 68, and that would pull me off the sidelines into that market. Okay, a dip down to 68 would be ideal. So look out for that coming up this week. It's probably a potentially great trading opportunity. Now, the other thing is look out for a surprise. If OPEC Plus says we're going to bring 2 million barrels per day back into the market, then obviously that could change things. So you've got to balance that all up. Manufacturing PMI data for US been very good recently. That keeps moving to the upside. That's supportive for the US dollar. Bank of England Governor Bailey speaking. Now remember here, if you're looking for central banks, go to my blog, blog.hycm.lab, and you can see I cover these central banks meeting. Okay, and any central banks meeting, I'll go over the Bank of England's last meeting. It'll be up tomorrow on the site, so go and check that out. But the key thing about the Bank of England Governor Bailey speaking is that he's revised growth upwards. He's revised inflation upwards. At some point, he's going to be positive about the pound. And so look out for the pound buying. Good value at the moment that I'm seeing in the pound is euro pound. I see euro pound downside. I think that's good value. So, looking at euro pound selling, okay, makes sense. I also see good value in pound Swiss franc. Remember, the Swiss National Bank are very, very they are very dovish. The Swiss National Bank has the lowest interest rates in the world, about 0.75%. So I see good value in the pound. Swiss franc pair, anything pushing back above that 1.28 region, fantastic. And I see really good value buying, kind of basically, I'm short, I'm already long in this trade, and I'm looking for this to move back up higher. The real, bonus point with this, get above that, and you're looking potentially back up to that 1.300 and then 1.3200. So they're the targets there. But there's a lot of upside potential here from a swing trade perspective. You can enter at market stops below 1.2553. Okay. Then if price moved that down, that would be the best area, that 1.2300 area. But from a swing term perspective, like just market from there, moving first target 1.3, second target 1.32. So I see value pound yen, pound Swiss franc, euro pound. Then, of course, we're going into the non-farm payroll, which is on the Friday, which we have already covered. So you can see, like, it's a slow start to the week, but it should get more interesting from Thursday and Friday. But remember those month-end flows. We could easily see quite a lot of volatile price action, and it can just be month-end flows that are responsible for that, and you might see a little bit of snappiness in the market. So just be aware of that. We are seeing mixed risk tone in the market at the moment. Seeing, you know, weakness in Aussie CAD, New Zealand dollar, bit of strength in US dollar, pound, Swiss franc, Japanese yen. So very, very mixed risk tones. Share equity markets, I'll give you a little clue. Always look at the VIX. The VIX is called the fear index, and it's for a good reason, because remember, equity traders, they're very sensitive to fear. They're very sensitive to weakness, risk off, and they tend to fall very quickly. So if the VIX, the volatility index, if you see this moving higher, like back up to above 17, 18, then you know that equity markets are going to start moving lower, okay? So what all the VIX is it's a fear index, and it just tells you the amount of people that are short the S&P 500. Now, it's a volatility measure of options. Now, when you know, a lot of traders are long the S&P 500, if they're frightened the S&P 500 is going to correct, they buy put options, sell options in the S&P 500. So when you see this rising, it means S&P 500 traders are fearing a sharp sell-off in the S&P 500. So if I just put the S&P 500 over the top, let me just, all right, you'll see here very simply, look, when the VIX rises, that's the VIX is the candlestick chart, the S&P 500 falls. Falling VIX, rising S&P 500, right? Let's just change the color of that so it's more visible. Right, you can see rising VIX candlestick chart, falling S&P 500, rising VIX, falling S&P 500, falling VIX, right? So, yeah, you get the picture. So you can trade the VIX as a fear index. It can be really good sometimes, you know, when you see a sharp spike in the VIX, just to short it. You know, one of the nice ways is to short it on a break of a trend line. It can be a very nice, simple trade. And you can see here, these good opportunities for shorting the VIX. So any spikes higher can be great opportunities. And you can trade that directly, the VIX. It's like trading fear. The key level is at 20 level. Stay below that 20 level. We are expecting more upside. So, you know, more upside is expected, but just be careful. Okay, folks, I hope that's helpful. I hope that's getting you ready for the key events. We've looked at quite a few different currencies, commodities. Any questions, please ask them. Remember, the only stupid question is the question that you don't ask, okay? So you can pop a question in there. It's good to see you, Trib, Selva, good to have you here. Sard, yeah, I was here. So just, you know, don't forget any questions, guys. Just put them in there, question box or the chat box. Yeah, the George A, good to have you here for the first time. That's lovely. Don't forget, if you want more updates, always check out my blog. I have a wealth of material that I put up there every day. Every single central bank meeting, cover it there. You don't need to be in confusion. I am putting up a new central bank overview. It will be up here soon. By tomorrow, that will be up here looking at all the central banks. Every single one in the major currencies will be there. Check that out. Also, don't forget, you can follow me at Twitter. I'm here at Giles Coughlin at C. That's me. I was a little post I did, a little fun post, speaking to a crypto bull, looking at Bitcoin. So that was a bit of fun there. But you can follow me here at Giles Coughlin CCA, and you can see that's me at Giles Coughlin CCA. That is my Twitter handle. I'll just put that out there. And don't forget, we are back here on Wednesday, and I will show you on Wednesday how to choose a currency to trade. Okay. Yeah. Hi, Christian. Good to see you. Ah, lovely. Yeah. US dollar, Swiss franc. Absolutely right. So US dollar, Swiss franc, you can see this strong rise in the Swiss franc. Now, this is a divergence between the Swiss National Bank and the Federal Reserve. With all of a sudden, remember the Federal Reserve is expected to increase interest rates sooner. We had the FOMC dot plot shift. And in the FOMC dot plot shift, the board members said that they now see interest rate hikes in 2023. Remember, whenever a currency is expected to, whenever a central bank is expected to raise interest rates, it means the currency rises. It's the most reliable kind of trading you can get is when you know a central bank is about to change its policy, when it's about to change its interest rate. And I think, let me just see, I did have a trade I took recently. I wonder if just bear with me, I'll show you this in real time. It will be helpful because, let's just bear with me 2 seconds. I'll just show you this. There we go. I think this is the one. Yeah, here we go. Here we go. This will be good for you. Right. This makes the point very well. Right. This was a trade that I took last week. Okay. Now, there's 2 trades, and I'll show you how I took them. The arrows are where I entered, red arrows are where I exited. Now, this is when the Bank of Mexico surprised markets with an interest rate hike. Now, remember, this is a surprise. So because of the surprise, it means the Mexican peso appreciates very quickly. So I took 2 trades, one on the announcement. I was a bit slow because I wasn't expecting it. And so I just called up my charts, made a quick short from here, just above 1980, down to just below 1970. Okay, just above 1970 rather. Okay, quick short. And then I was going to bed and I saw price retrace, and I thought, you know what, I'll just take another quick short down to that little tribute line. That can all take place while I'm sleeping. Just put my stops above the highs, and I got my second trade. And this is because the Bank of Mexico increased interest rates. So increasing interest rates means the currency appreciates. You got it? Now, SARD, the US dollar, Swiss franc, what's happening here? The dollar's appreciating. Why? Because markets are expecting the interest rates to increase. Okay? So that's what you want to look out for. Because of that, we've got US dollar upside. So this pair will be pushed and pulled around on expectations of what's happening on Friday. So what you're expecting for the dollar is going to impact the US dollar, Swiss franc. If the employment is very strong, expect this to keep going higher. If the employment is weak, expect this to pull back. If price pulls back to that 0.9050, 0.9900, that is a buy zone. As long as the Federal Reserve expected to increase interest rates, that is a value buying area, SARD, okay? Don't want to buy in at these highs. It's too high. Potentially as shorting the euro US dollar is very similar trade to the dollar Swiss franc long. Okay, so a euro US dollar short is very similar to a dollar Swiss franc long. The Swiss National Bank, very, very bearish central bank. So this is mainly pushed and pulled around by the dollar. So I hope that makes sense. Yeah, and Sard also asked a very good question. What's the revisions? Now, revisions are important. Okay, if you look here, you can see the last non-farm payroll data was 559,000 jobs. Now, when this data is released for July, at the end of this week, there's sometimes a revision. Now, imagine if that revision was 800,000 jobs added. What would that tell you? It would tell you that the situation is better than expected. So revisions can move the markets. It's a bit like if you said to me, Sard, you know, how much money do we have to spend? You know, imagine your kids say to you, Sard, you know, if you have children, or, you know, just imagine a dad and the kids say, how much money do we have to spend when we go to on holiday, Dad, at the theme park? And you say, right, you have £50 each to spend. Great, they think. But imagine when you're just about to go and they say, right, we've come for the money. And you say, don't worry, kids. Actually, I thought you were going to have £50, but now you have £100. They will be doubly happy, right? It's exactly the same with revisions. When something's revised up, it can move markets, and similarly if things revised down. I hope that makes sense. Laura, new to currencies, thanks for this Monday opportunities to learn. Laura, it is my pleasure. I really enjoyed teaching currency trading. A couple of things to point out for you. Look at this trading insights section on the lab. Okay, this will really help you. Okay, make sure you check this out. Start reading. What you're really looking for is actually, let me show you. Like, if you go on my Twitter handle, follow me here. I've been putting out a few good lessons, Laura, but one lesson you really want to get down, I'm going to send you the link. I posted it last week. There's a few of them, but right, this is very helpful. Okay, so I'm going to send you the link to that Twitter post, Laura. Have a read of it. If you're new to trading, check that out. Okay, and don't worry, and also get in touch if you ever want any help. I have various programs to help people, really take trading seriously, so that they set up on a good foot. We're very passionate here at HYCM at helping people learn to trade. It's tricky, okay? I'll tell you straight away. It takes time and dedication, but it can be learned, and starting the right way is great. Oh, Saad, you're 21. You don't have kids. Enjoy the peace, Saad. Enjoy the peace. Great, good questions. Yeah, Laura, that's good. Check that out, Laura. It's basically strength against weakness. You'll see in that lesson. Think about currency trading like that. You're wanting to see banks that are raising interest rates, and you want to pair that with banks that are cutting interest rates. Keep coming to this webinar Monday by Monday. If you haven't already signed up to be a client with HYCM, do so, because then you'll get access to the Wednesday webinar. And over the course of time, we want to, really develop this so you can really always get help and understanding what the dynamics are in the currency markets. So very good to have you on board. Laura, that's great, absolutely. And don't forget, you can reach out to me, and I am here to help, particularly HYCM clients. I am here to help. Folks, thank you all very, very much. And good to be here. Have a great trading week. And see a lot of you on Wednesday. And aside from that, I'll see folks again on next Monday. Take care now. Look after yourselves. Goodbye.